Chapter 1: The Limitations of Buy and Hold. The buy and hold strategy, a cornerstone of traditional investment advice, rests on the premise that consistent long-term investment in a diversified portfolio will yield superior returns over time. This approach, often championed for its simplicity and avoidance of frequent trading, has undeniably proven successful under specific economic conditions characterized by relatively stable growth and low volatility. However, to present it as a universally applicable, infallible strategy in today's dynamic and interconnected global markets is a significant oversimplification, bordering on a fallacy. The inherent assumption of consistent market growth, which underpins the buy and hold strategy, is frequently challenged by unforeseen events and cyclical market fluctuations. The historical context of buy and hold is crucial to understanding its limitations. Its rise to prominence coincided with periods of sustained economic expansion and relatively predictable market trends. The post-World War II era, for example, witnessed a prolonged bull market, providing fertile ground for the success of this long-term investment strategy. During this period, consistent investment allowed for significant capital appreciation, reinforcing the belief in the power of buy and hold. However, this historical success does not guarantee future results, a crucial point often overlooked by proponents of this unwavering approach. The reality is that markets are inherently volatile, and significant deviations from a consistently upward trajectory are inevitable. The buy and hold approach, with its inherent passivity, often leaves investors unprepared for and vulnerable to these market downturns. Rigid adherence to this strategy can lead to substantial losses, especially during prolonged periods of market correction or crisis. Consider the dot-com bubble burst of the early 2000s. Many investors, convinced of the long-term growth potential of technology stocks, held on to their investments despite growing evidence of an overvalued market. The subsequent crash wiped out billions of dollars in value, leaving those who steadfastly followed the buy and hold principle suffering significant losses. Similarly, the 2008 global financial crisis exposed the vulnerability of a buy and hold approach. The unprecedented market crash caught many investors off guard, highlighting the limitations of a passive strategy in the face of systemic risk. Those who had blindly held onto their assets, expecting the market to recover swiftly, experienced substantial and prolonged losses, some even losing their life savings. Furthermore, the buy and hold strategy often fails to account for the changing economic landscape. Globalization.
Sample complete. Ready to continue?